Ladies and gentlemen, good day and welcome to the Q2 FY21 earnings conference call of India Great Trust hosted by Axis Capital Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhishek Puri from Axis Capital Limited. Thank you and over to you, sir.
Yes, thank you, Rituja. Good afternoon, ladies and gentlemen. On behalf of Axis Capital, I am pleased to welcome you all for the India Great Trust Q2 FY21 earnings conference call. We have with us today Mr. Harsh Shah, CEO and whole-time director of Sterlite Investment Managers Limited, representing India Great Trust on the call. We will begin with the opening remarks from Harsh on the operational and financial highlights as well as the key updates for the sector. This will be followed by the Q&A session. With that, I hand over the floor to Harsh. Over to you, sir.
Thank you, Abhishek and Jiten from Axis. And I welcome all the investors and stakeholders who have joined the call today. I'm very happy to present this is the quarter 2 results and a half year for FY21 results. And I will take you through the presentation in the first 15 or 20 minutes, and subsequent to that, we'll open for question and answers. To start with, I am on slide number 5 of the presentation, which you may already have. I would reiterate our vision. Our vision is to become the most admired yield vehicle in Asia, focusing on focused business model, which is on long-term contracts, low operating risks, and stable cash flows. Focus on value accretive growth, and we'll talk about it in a little detail as we did a couple of acquisitions this quarter. Predictable distribution. We have been maintaining a quarterly distribution and giving guidance on that front and ensure that we are meeting that. So that's another pillar on which our vision stands. And the last one is to maintain an optimal cap structure, which ensures that our balance sheet remains strong, as well as we ensure that we are optimal to provide the adequate returns to investors from the assets. Coming to the slide number 6 on the next page, which is about just a reiteration and introduction to our portfolio. We have an AUM of about 14,000 crores. This increased because we added 2 acquisitions in this quarter. The acquisitions in this quarter are showcased in green on the right-hand side chart. One of them is GPTL, Gurgaon Palwal Transmission Line Limited, and the other one is Jhajjar KT Private Limited. The first one we acquired from Sterlite Power and was part of the framework assets. Jhajjar project we acquired from the joint venture of Techno Electric and Kalpataru Transmission Limited. With this assets acquisition, and the size remains now today at 14,000 crores. We are in 14 states and 1 UT, own about 28 lines and 6,280 circuit kilometers, 9 substations and 11,460 MVA of transformation capacity. We have reiterated our AAA rating as well as our contractual period, which remains to collect from the cash flow is still about 32 years left from the existing assets in the initial contract. There are approximately 9,700 towers, and overall weight of all the metal put together is approximately 3,071,000 metric tons. The key highlights are on slide number 8. I'm moving to slide number 8 on key highlights for quarter 2. Our EBITDA grew 14% year on year on the back of maintaining our availability at optimum level, as well as the acquisitions that we have done during the year. We have maintained the DPU at 3 rupees a unit in quarter 1 as well as in quarter 2, despite the COVID-related uncertainties that existed. At the beginning of the year, we had not provided the guidance considering the uncertainties related to COVID. However, we had said that we believe that our performance would remain on track, and I think in line with that, we have maintained and delivered a 3 rupees a unit distribution. Our net debt to AUM is still at 54%, and there is significant headroom available for us to grow and still remain within the 70% cap on leverage that is as per SEBI regulations. We discussed the rating at AAA by all three rating agencies. Portfolio growth is something which is important. We have been growing, and overall we have grown about 60% CAGR since IPO, both in terms of assets, P&L, cash flows, and these two assets are in line with that strategy. We have acquired GPTL for about 1,075 crores and Jajjar KT Transco Private Limited approximately 310 crores. This unique development that happened in this quarter, where we had taken investor approval to add our largest investor, KKR, as a sponsor. We did the EGM and took approval of special majority approval by all unit holders, so 75% of the unit holders in the AGM. And this is not present and voting, this is of the entire unit holder base. 75% has been positive, that KKR as a sponsor. Our shareholding is fairly diverse, and about 60% are owned by FIIs, including KKR and GIC, and approximately 20% are owned by DIIs, including 8 insurance companies, 4 mutual funds, and 3 employee pension funds. Regarding COVID update, and we'll cover that slide in the next slide detail, we believe that the collections have come back on track, and we have received about 113% collection for Q2. Our availability is still maintained at 99.5%, and no material impact that we see on power slowdown, which was existed in Q1. Rather, the scene has turned around now, and we are seeing month-on-month basis power growing. On regulation side, the SEBI has been kind enough to make consistent upgrade of the InvIT regulations, induction to a new sponsor, declassification of sponsor, regulations around those was made available to all InvITs in this quarter. And as we said, we chose to induct new financial sponsor on our platform on the back of these regulations. I'm on slide 9, which talks about COVID impact and as such what is happening on the industry on account of that. First, I would like to clarify that transmission companies are not directly impacted because the power flow, or rather the revenues of transmission companies are not linked to power flow, but only based on availability of transmission lines. And considering urgent and important service, we were also given special exemption to operate during lockdown to ensure that availability of our lines remain healthy. However, as a health of the sector, power demand and peak demand both represent a good measure, and we have seen, as you see on these charts, and we have been monitoring these charts on a regular basis, power demand has rebounded and clearly indicating the economic activity is picking up. And September exit itself is approximately 6% year on year, and if one looks at October, the number is widened further. So we are clearly seeing overall coming back of the economy as well as of the sector. And if one looks at the power consumption and peak demand as a high frequency indicator, that is something improving on a week by week basis if we compare it with 2019 numbers. There is also a recovery in terms of our collections. The collections were low in Q1 as we had guided at the beginning of the year. However, consistently since then, on a month-on-month basis, we have seen collections improving. And if you look at the chart, the blue graph, which represents the existing collections, is clearly showcasing a recovery starting from 40% and going up to now in September 130%, which represents approximately 92% of the cash flow which we have received YTD, which is a significant amount of catch-up that we see in H1 itself has taken place. We believe if this trend continues, and we are positive about this trend continuing, by Q3, we would have collected whatever was a shortfall in Q1, and we'll come back to a regular cycle. On slide number 10, I will take you through certain operational highlights of the business. As you can see on the chart on the left top, our availabilities have remained higher than the normative availabilities and substantially over 99.5%, which results in accruing incentives for us. Our contractors have relevant HSC training, which we focus on in design. We invest in behavioral-based training, which is also something which is a consistent approach. There is one, I would say, incident that happened in our portfolio, which was undesired incident, but we experienced a fatality of one of the subcontractors on account of a very rare occupational hazard of a bee swarming. It's one of the very rare biohazard. However, we are ensuring that adequate preventive measures are implemented for not repeating it. Regarding COVID, we have approximately 600 people, including partners on our operations. We have experienced 3 COVID incidents, which was 0 till last quarter. However, all the people have recovered, and we are ensuring that the COVID-19 test and negative is mandatory prior to joining for new members on our worksite, and ensuring compliance for all the other social and security requirement by the government. On the left-hand side, the key indicator of number of trips per line, we are investing substantial amount of effort to ensure that our corresponding trips per line comes down. And as you can see, we are at 0.27 versus 0.46, which is a substantial reduction in terms of trips per line, and we are focused on ensuring that this remains there or goes down by adequate preventive maintenance measures taking place. On slide 11 is the financial highlights of quarter 2. As you can see, our revenue for this quarter, or consolidated revenue for this quarter, is 328 crores. Our EBITDA for the quarter is at 303 crores, and which has resulted into a DPU of about 3 rupees a unit, which will translate into about 175 crores of distribution that we are doing. Our revenue is up 17% on a year-on-year basis on account of acquisitions that we did this year. EBITDA is up on a 14%, and in all, since listing, now we have distributed 39.56 rupees a unit, which includes approximately 1,600 crores of cash that we have paid. Going to slide 12, which explains the consolidated EBITDA to NDCF waterfall. So starting from revenue at income 384 crores, going back to SPV level expenses of 33 crores, 33 crores, with EBITDA of SPV coming at 351 crores. Interest that we have paid in SPV is 45 crores. Working capital is about 12.3 crores. Reserve that we created at SPV to ensure that we utilize the additional liquidity for stabilizing our DPU is about 10 crores, which leaves us the NDCF at 284 crores. At the IGT level, the interest that we paid is 91 crores. Expenses at the IGT level is 5 crores. Tax about 4 crores, which is largely on the interest income that we earn from treasury investments. And therefore, NDCF at IGT consolidated is 1875 crores. We are creating a reserve of 12.5 crore and effectively paying 175 crores, which is corresponding to 3 rupees a unit. Going to the next slide, on slide 13, is a snapshot of our balance sheet. As we have discussed, we are a AAA entity. Our weighted average cost of capital today is at cost of debt today is at 8.5%, owing to the fact that we have locked in interest rate at different point in time. Our cash balance at the end of the quarter was about 697 crores, which includes the distribution of 175 crores. And we have a fairly healthy EBITDA to interest cover in the portfolio. As you can look at on the right side on the sources of borrowing, we have a good mix of market borrowings, which includes debentures and MLD, as well as we have a good mix of bank loan and ECB, which are longer term. And we believe that we'll continue to maintain this balance between sources of borrowing and utilize that in the new environment where possible refinancing would result into better interest cost. Slide 14 is about the total return that we have delivered. This includes the DPU that we have paid since listing and also the price change that has taken place. This is price as on 30th September 2020, which is about 106. It includes about 42% of total return, and if one was to annualize these returns, it's 11.2% since listing in June 2017. We also compare with different investable universe, starting from a GSEC to transmission utility to power indices, utility indices, and overall wider stock market. And we clearly see that because of the higher payout ratios, as well as a stable performance, we have outdone, or rather on total return basis, delivered a superior return, especially keeping in mind a beta of closer to GSEC in comparison to any other indices that you see. On slide 15 is just a comparison about how INDIGRID is placed vis-a-vis global yield platforms. I would say we are significant in terms of size in India. However, there are much larger global yield platform, and therefore, as we achieve our size aspirations, we believe overall liquidity would improve, and overall, I would say trading yields that we see for most of the large, good performing yieldco with respect to their domestic risk-free rates would probably improve. Looking ahead, the outlook for full FY21, we are focused on portfolio growth. So we are going to evaluate two projects on which we have signed framework agreements, which is NER and KTL, which are owned by Sterlite Power. We are focusing on the diligence and ensuring that we are ready as and when the assets are completed to acquire them. We are also evaluating select opportunities in solar sector with central counterparties. At this point in time, we have not signed any agreements. And we are also committed to create a pipeline of transmission projects besides the existing pipeline of projects that we have. Second priority for us remains maintaining a strong balance sheet. We are maintaining adequate liquidity to mitigate any current uncertainties that may pan out further on account of COVID. We're maintaining sufficient cash balance and working capital lines for ensuring our operations remain healthy and the business does not suffer. In addition to that, we're also looking to diversify our debt sources to elongate our tenors and incremental facilities and also reduce the cost opportunities. Third section is about asset management. We believe this is a significant pillar of our business as a utility. We will continue to strive to maintain the highest availability for our portfolio. We are also choosing to make investment in technology in terms of digital asset management and predictive analytics, including and emergency preparedness, which includes investment in digital tools, includes emergency restoration systems, which enables us to restore lines faster, which ensures the overall reliability is superior. Our focus on ESG and ESMS is increasingly higher, and we have finalized our ESMS framework, and we will be publishing the details around that in subsequent quarters. The last one is about indices stewardship. I think we recognize InvITs as a significant infrastructure investment opportunity for the country, and we are investing both time and bandwidth to ensure that we increase awareness about INDIGRID as well as InvITs in general, which will result in wider participation as well as improved liquidity and understanding about the product. There have been policy initiatives which we are pursuing with the government with respect to enabling IRDAI and PFRDA to subscribe to debt securities issued by InvIT. We are also engaging actively with regulators to reduce the trading lot size to single unit, which we believe will eventually result in better proliferation as well as liquidity for the instrument. In all, what we are looking at is towards delivering superior returns, maintaining stable DPU, and growing NDPU. I would conclude over here. There is a detailed section about the overview of our assets and INDIGRID journey, which we have shared in the presentation. I would be happy to address any questions now that may come regarding our performance as well as business in general. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mohit Kumar from DN Capital. Please go ahead. Mr. Mohit Kumar, your line is unmuted. Please go ahead.
Hello. Good evening, sir. Am I audible now?
Yes. Yeah, you're audible, Mohit.
Good evening, sir. Congratulations on good set of results. Sir, my first question is on the guidance part. Are we giving any guidance for FY21 on the DPU? And do we expect the guidance to the DPU to increase going forward? Because you already have healthy cash on the balance sheet. I believe roughly around 350 odd crore additional. Am I right in saying that?
Yeah. Okay. So two questions. I think one is on the guidance, and then second is sub question on that about increasing guidance. So I think we decided early of the year that this year we will not give guidance on account of uncertainties on account of COVID. I would say from the business or the company perspective, the risk premiums have come down and the COVID uncertainties have reduced or rather gone away. However, as a country and as a business, that still remains. So, and considering that we are mid of the year where we already delivered 50% of what potential guidance, we would give a guidance for FY22 in quarter 4 instead of really giving guidance for next 2 quarters. So we are formally still not giving any guidance for next 2 quarters. Yes, the collections have come back, the performance is good, the business is fine, but considering we are already mid of the year, we would look to give guidance in quarter 4 along with the results then, for the entire next year instead of giving it for just 2 quarters.
Okay. Secondly, on the receivables, so can you quantify the receivables for the last 3 quarters, in the sense at the end of FY20, and what it was at the end of June 20, and what is it now?
Okay. So if I get your question correctly, you wanted each quarter what was the receivable days outstanding?
Yes, you have to take time to figure out the movement. Yeah.
Okay, so I have 2 data points at this point in time with me, which is at June we were about 101 DSO days. In September we are 83, and if I'm not wrong, and again because I don't have that in the presentation right now, I think it was approximately 60 days in March.
Understood, sir. And lastly, on the debt side, of course, we now have 80 billion debt, and we'll further have 30 odd billion debt going forward. What is the strategy to reduce the interest cost and elongate the repayment? I believe there's a 26 billion repayment is due in FY23, which is also not very far away. And what is the scope to reduce the interest cost from going forward?
Yeah. No, so I think there is a significant scope to reduce interest rate cost. However, it comes as a trade-off to the tenor, but our interest is to elongate the tenor. But incremental costs have substantially come down. However, most of our balance sheet is fixed, so the overall weighted average cost of borrowing may not really go down, in a year's time, because a lot of that is fixed market instruments, so they remain where they are. However, incremental cost of borrowing has substantially come down. Coming to the FY23, I think it's not one repayment; it is spread across full year. And we believe, considering our entire size, it will not be a materially large for FY23. However, we are cognizant of that, and we will be making a plan somewhere closer to FY22 to ensure that refinancing takes place. Considering their market instrument, even if we want to, it is just not possible for us to, prepay it right now. And therefore, we'll have to strategically just keep liquidity available and start early, as and when, we are closer to FY23.
Understood, sir. Thank you.
What we are taking care of is that we are not adding any more liabilities in FY23. So that's something which we can guide.
Yeah, that sounds good, sir. Thank you, sir. Thank you, and best of luck.
Thank you.
Thank you. The next question is from the line of Smarnim Maheshwari from Edelweiss. Please go ahead.
Yeah, hi, sir. Good evening. Thanks for the opportunity. So once again, a stable set of performance. Congratulations for that. Couple of questions. First one, on the collection side, now you did mention that the collections have bounced back to 113% in Q2. But I think that still implies that there is some amount of Q1 data which still needs to be recouped. If yes, what's the quantum? And what is, there is some devolvement of the factoring also. So any updates over there?
Sure. So thank you, Swarnim. So to give you a color on that, we have on a YTD basis collected approximately 90% of our revenue. Okay. So that gives another 10% is to be collected in a simpler way if we were to put it across. So we are focused on is that in the quarter 3, we are monitoring the trend closely, and we feel that by end of quarter 3, this 90% may be around 95, 97% as well. And I'll call that number is a fairly healthy number. We'll come back to almost normal with that. To answer the second question that you asked on factoring, we did use factoring in quarter 1 when the receivable days were lower. However, in quarter 2, the 113% collection does not count factoring. So rather, we have repaid the factoring that we did in quarter 1 of receivables to ensure that, we are not running a factoring-led recovery. So this is right now what we see, approximately 90% is without factoring. So we've actually repaid approximately 86 crores of factoring in quarter 2, which was factored in quarter 1 for NDCF, which is now, the catch-up has already taken place.
That's really good. So that means that there is no factoring, right? There is no outstanding factoring right now.
No, there is 54 crores of outstanding factoring.
54 crores.
54 crores. We paid 86 crores of factoring in Q2. There is still 54 crores of factoring in our other balance in quarter 3.
So 54 crores is yet to be paid. Okay.
Yeah.
Right. Good. Sir, secondly, now, you will see that there is a reserve that we have created at both the SPV level and the trust level. Is this DSRA or is this something else? If you can highlight something over there.
Okay, so this is not DSRA. DSRA is not statutory. It's a reserve created for the benefit of debt investors. This DSRA is the 10% flexibility that INDIGRID has in terms of its NDCF, which enables us to, smoothen the volatility on a quarter-on-quarter basis, right? So by doing this, we avoid that on a quarter-on-quarter basis, there's no volatility at, in some quarters there's 3.2, the next quarter 2.8. We believe that's slightly more confusing and complicated for investors. So we manage this 10% buffer or reserve to ensure that, we can smoothen on a quarter-on-quarter basis with 3 rupees weekly.
Got it. Yeah. So I was just looking at, you have created that at the SPV level also, but yes, the rules permit that 90% distribution. So yeah, 10% is within the limit.
Yes.
Got it. Sir, the third question really is on the renewable. Now, if you see KKR recently had set up a renewable InvIT platform, and we are also eyeing the renewable assets. Is there some sort of conflict of interest over here, and how will this work if you both are eyeing the same asset, so it can be acquired by you or by KKR? So, how does this work really?
Okay. So I think, while I may not be able to describe about their plan, but as per what you see from the press release from KKR, their intention is to acquire portfolio of assets which includes SECI and non-SECI or NTPC. So basically a mixed set of assets which includes solar, wind, central counterparties, state counterparties all put together, right? So that is their strategy as per the press release, whereas our strategy is to only focus on operating projects with a track record with central counterparties. And therefore, we are, I would say, targeting a very limited universe of assets. Now, coming to in terms of competitiveness, I believe we being a AAA as well as having only focus on operating assets for I would say developers or sellers, we may be able to offer a better value proposition, and therefore if there is a bid, we believe we might be more competitive. Whereas if developers want a total solution where they monetize the entire portfolio, probably the other platform maybe we will stay out of it, so probably they can compete on that. So therefore there is a natural segregation of business models, right? So business models don't overlap. Having said so, to give you clarity, in cases where there is or there may be a conflict of interest, KKR, as per the shareholder agreement as the manager, KKR will not be voting in terms of the decision making, or KKR will refrain to vote if there is a conflict of interest of this kind. So I believe that addresses the, if at all there is any conflict of interest that may arise.
Yeah, so that implies that, for example, if you are looking for an asset which is secure NTPC as a counterparty, so for that acquisition will not be voting for the acquisition of those assets. If KKR, like IndiGrid platform, is also buying or eyeing for those assets, is it?
Not just any that platform. As for the the corporate governance is at a much different level. If there is any conflict of interest by KKR invested entity, not just this platform, if there is, they are privy to such information or companies, they will refrain from voting. Yes.
Okay. Got it, sir. This works well. Get back in the queue. Thank you.
Thank you.
Thank you. The next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Thank you, Harsh, for the opportunity, and congratulations on another set of stable number. So first question is, I think we have been making DPU accretive acquisitions. So if you can keep the number of what is the total buffer right now that we have, which could have been paid but has not been paid, and of that, how much has come through new acquisitions?
Okay. So the number that you asked specifically as a net number, I may not have right now. We'll need to sum up all the past financials because it's not a balance sheet reserve per se, right? That gets created. So the indicative reserve, if I were to say over and above DSRA, we have approximately 64 crores of the reserve. But this is an approximate number. This is not a statutory.
But number, including right? At SPV level?
Yes, including total reserve. Right?
So it's only 64 crore which we could have paid but have not been able to pay.
Exactly. But you're right. So exactly. It's not that we have retained a lot of capital on account of that. Right?
But right now, what can be the run rate of this every quarter?
Yeah, I was coming to that. So if you look at the last 2 quarters where the acquisitions have taken place, again, some of them are mid-quarter acquisitions, etc. But the run rate with the existing assets without, I would say, or with normalized receivables, right? So no surprise on that front, is approximately 200 crores, right? So if I were to calculate on a quarter-on-quarter basis, there's about 25 crore addition that happens on account of this. Okay. Again, the numbers can go up and down because of different assumptions on working capital, etc. But on a run rate basis, 200 crore is the NDCF run rate that one can see in Q1 and Q2.
Okay. And secondly, while we performed very well in all the metrics, but one metric where we have sort of not been able to take advantage of is on the cost of debt. So even in FY19, if I recall, it was close to 8.45, and now we are at 8.5 in a time when even retail home loans are below 7 now. So I think we should find a way to optimize it, because there is an opportunity to make a DPU accretive reduction in cost of debt right now. And if we wait far long, then we may lose this opportunity. Although the 12%, although our DPU doesn't changes, but when we are given an opportunity to make a DPU accretive reduction in the debt, why not go for it? And even if we can utilize some of these excess reserves to do that one-time activity, probably it is worth doing it to sustain a higher DPU for the longer time, to take a one-time expense.
Understood. So Saroj, I think a very, very important point that you made. I think one needs to look at this as a test match, right? For example, in FY17-18, our focus was to ensure that, and it still is, to ensure that there is less unpredictability and less volatility, right? And therefore, we have done a fixed rated instruments, right? The moment you do a fixed rate instruments, there is a downside to it, that if the market was to go down too low, you feel that, you have lost the spread. But on the other hand, if the market was to go too high, you would be protected, right? So there's a trade-off of that. And what you said next is important in terms of, can you pay the breakage cost and premium cost and, refinance it? So I would say the reserves, at the end of the day, if we use the reserve to pay a breakage cost, we keep evaluating if it, in the end, becomes a more accretive for investors. At the moment, our focus is to ensure refinancing loans and bonds where there is no breakage cost as well, right? So, as I said, we are opportunistically looking at it, but it's a large book, right? On a 7,000, 8,000 crore borrowing, you can't really go one day and refinance the entire book. That will be a substantially higher cost, right, at a market instrument level. But directionally, as you said, we are focusing on it, and we are evaluating ways and means to, I would say, monetize different instruments as and when either the maturity comes or the trade-off is in favor.
Yeah, if there is some way to get a long-term financing at a much lower rate given the interest rate scenario and lock it in, and given that we have locked up revenue profile, it would be amazing for us.
Yeah, no, correct, fair enough. Yeah.
And then, if DPU increases, then your market price increases, then maybe you can do a pref, you can acquire more assets, then those can be DPU accretive. So there can be second order impact on DPU as well because of that step.
Yeah, no, fairly, I agree with you, Saroj. I think our decisions are more to do with risk management than necessarily, work on the share price. But I think directionally you're right. We are monitoring it very closely, and as and when we do something, some unique refinancing, you'll see the output. For example, right, one of the assets which was OGPTL, we had a borrowing which was at around 9%, which we have reduced to 7.7%. Now, this is a 600 crore loan. We have reduced it without refinancing, just by bilateral discussing with the investors in bank, and they reduced it without a breakage cost, right? So it is a slow process, right? But we are on it, and as I said, one of the loans we have refinanced, which went down for about 1.25% cost of interest, right, for that loan. So as and when it moves on, we'll keep doing it. But a 600 crore reduction may not reflect directly on a 7,000 crore book, right? So, but you will see it happening over a period of 6 to 12 months incrementally.
Understood. And the outstanding value on your collections in H1, can you just tell me the number?
Okay. Sorry. So
rough number.
Yeah, rough number would be it's 600 crores, about 50 crores. 50 crores, I would give a number about 50 crores, right?
Okay.
About
Thank you.
10% of our overall revenue.
Thank you, and all the best for the coming quarters.
Okay, thank you.
Thank you. The next question is from the line of Hitesh Arora from Unifi Capital. Please go ahead.
Yeah, hi, Harsh. Congratulations on a good set of numbers. Just on this, on the NER asset, I understand the scheduled completion date was November this year, so this month. What's the status on that? Has it been commissioned, or is it soon to be commissioned? How's it looking like?
Okay. So I mean, it's done by Sterlite Power, but we are evaluating it. At the moment, what we understand is that this is right now one of the elements. I think a few of the elements are at the commissioning stage. I mean, that asset has several elements, but the full asset is not commissioned. But few of the elements are on way to commissioning in November itself. That is what we believe.
So one of the elements is not commissioned, is left.
No. One of the elements is getting commissioned in November now. Few of the elements are getting commissioned now.
Okay. But what's your you would only acquire once everything is commissioned?
Yeah, I mean, see, we can acquire if few elements are not completed. I think it depends on the size, etc. Because we do have a 10% limit that we can play around. But I think if the project is at the last stage, small element is pending, probably we can acquire with adequate mitigations. But it is too early to say right now. Right now, it's just commissioning its first few elements. There are more. So we'll have to see as it goes. And as and when we acquire, we'll obviously come for announcement and unit holder approval for that as well.
But what's been sort of the commentary from Sterlite around the time of completion of the project? Any sense there?
Okay. So commentary has been that I think by quarter 3 or quarter 4 it will be completed.
Okay, quarter 4 this year.
Yeah.
Okay. Fine. And there was another asset as well, the KTL, I believe. That will be before that or after NER?
We believe that will be after NER. The KTL is already commissioned. About 55% of revenue is already started, and that's commissioned and utilized. The other part of the asset is delayed on account of some clearances, and they are seeking both relief as well as clearances. So we believe there is a delay on that, and Sterlite Power has also extended the framework agreement on account of that delay. So the framework agreement has a long stop date of December 2020 for KTL, which is now extended to COD plus 12 months.
Okay. Thanks. Any high-level information? See, once you get to these assets, once you acquired KTL and NER, I would presume you would hit your leverage limit. Any thoughts around capital raise post that? If you think you can discuss now or give guidance now.
Yes, I think this is slightly too early for discussion on guidance on capital raise. I mean, we've not even acquired NER, which is the larger one. So as and when we are closer to reaching the debt limit, should be the right time. I think this is too early for that at this point.
Okay, fair enough. Understand. If there's something else, we'll come back into this. Thank you.
Sure. Thank you.
Thank you. The next question is from the line of Nimesh Rathod, an individual investor. Please go ahead.
Hi, good evening, Harsh. Congratulations for the numbers. As always, good numbers. Just a couple of questions. One is I noticed that you've taken a slight hit in the EBITDA margin by about, I think, 2.3% or so. Would love to know if there is any specific reason for this. And second is, you spoke about it in the opening remarks about the fatality that happened. To me, as an observer, it probably has shot up a red flag on the risk management process that we follow at the operational level. Would love to know what exactly are we doing to make sure that the risk management processes are in place. Thanks.
Sure. Thanks. So I think the first question that you have asked on the expenses, I think there is an accounting adjustment that has taken place. There were certain earnouts that we were to pay to Sterlite Power as and when we receive cash on account of certain tax refunds or certain other cash recoveries from the past activities. So we have received cash for that, which was already a current asset in the book, but we have paid them as an expense, and therefore you see a marginal increase on account of one-time items, which reduces the EBITDA in a small manner. So that's just a one-time impact that has taken place. Second, I think what you made is a very, very important point, and most of the time the work that we focus on is not working at heights or in jungles. Most of our work is below to monitor a tower. But as and when we do it, we do put adequate precautions. However, this is an incident which actually surprised us, to be honest, and we are taking it seriously. There is a lot of I would say diligence, evaluations, investigations already done on it, and we are on it to ensure that this does not repeat. And also, not just this, any other incidents which potentially have not thought of can also be prevented. So our focus is to ensure that we beyond at the end of the day it's a loss of life. So we are cognizant of that, and I would say we are doing our best to ensure that we improve from here.
Great, thank you.
Thank you.
Thank you. The next question is from the line of Abhilasha Satale from Dalal and Broacha. Please go ahead.
Thank you for giving me opportunity. Sir, just a couple of questions. Like the interest paid at ITT level during the quarter has increased from 80.7 crores in Q1 FY21 to 91.1 crores in Q2 FY21. So what is the reason for this? And my second question is on the solar assets. So what kind of pipeline we have for solar assets over next 2-3 years? Yeah, thank you.
So I think first question, it is just that after quarter one, we acquired GPTL about end of quarter one. So the interest cost of GPTL and other acquisition have come in quarter two in the PNL. So that's something, one, interest expense at IGT level, right? The assets have increased in quarter two. The second was on solar pipeline. I think we have not even acquired the first asset yet, right? So I think the better question is when will we acquire first asset? We are working on it. I think pipeline is the next level. I think our focus is to go slow, go steady, but go sure. And a pipeline is when we have developed a far bigger business plan to grow. As we have communicated in earlier call, we will grow surely, but slowly but surely. So at the moment, our focus is to ensuring that the assets that we are looking at, we are bidding for, are right assets. We have taken adequate precautions for that and are adding substantial amount of accretion to investors. And post that, we will really work on the pipeline. So I would say our focus is to ensuring what we have at our hand to conclude that, consummate that in a safe way.
Sir, I just meant to say that do we have any number, the current projects in the pipeline or so many bids we are looking to have over, say, some visibility in terms of say over 1 year?
Yeah. So Abhilasha, we do not bid for projects, right, on solar. So we are dependent on as and when people want to monetize the portfolio. We are evaluating several transactions. We know some people want to monetize, some people want to monetize a year later. But in general, what I can guide you towards is that the overall market is growing. Overall number of bids that we have seen are very encouraging. There are a lot more projects coming to auction, a lot more projects coming to commissioning, and which results into a larger pipeline for us in the next 2-3 years. Now, if we were to remain, to our cap maximum about 20 to 25% of our AUM, over a 2-year period, our overall goal is to reach 30,000 crores. So about 20 to 25% of that would be about 5,000-6,000 crores of total size, right, of solar in the overall portfolio. So if you reverse calculate, that will come to about a gigawatt, right? Now, as we have said before, we don't work for size. We are not necessarily want to acquire a gigawatt. We don't have that aspiration. But if I were to give you a size maximum, what we can do in a 30,000 crore portfolio, maximum we'll do is about 5,000-6,000 crores of solar, which would turn out to be approximately a gigawatt.
Okay. Yeah. Thank you.
Thank you.
Thank you. The next question is from the line of Dwanit Savla from Unit Holder. Please go ahead.
Hello, sir. Am I audible?
Yes.
So my question is two parts. Firstly, there is this political crisis arising out of some power issues in Punjab. I see that we have some connections over there. Is it going to impact our revenues in some way? And secondly, sir, I wanted to know, is there any plan of reduction in our debt? If it's not refinancing, I know that people have asked about refinancing, but are we planning to pay off and reduce our debt going forward?
Okay. So first question is, I think we don't have exposure of the particular crisis in Punjab that is taking place. Our asset in Punjab is a TBCB asset, so interstate transmission connection asset. So therefore, we are not directly linked to that. We don't have impact of that. The second one was reduction. Yes, we would eventually reduce the debt. Our goal is to, in 30 years, to repay all the debt. So our debt reduction strategy will start when we reach 65-70% of overall debt to AUM, and we will start amortizing debt. So if we were to look at a full life cycle, we are growing right now, so we are increasing debt. When we reach 65-70% of debt, we'll start amortizing that, and before the concession agreement ends, let's say in 25th or 30th year, we would have amortized full debt. So I think debt reduction one must look at in the entire tenor instead of the first few years.
Right. Thank you, sir, and congratulations on an amazing quarter.
Thank you.
Thank you. The next question is from the line of Rishabh Sharedalal from Pravin Ratilal Share and Broker. Please go ahead.
Thank you. Thank you for the opportunity and congratulations on good set of numbers. Just wanted to understand regarding the component of DPU, that is reduction in, the face value. The company has actually distributed that portion just 2 times in whole listing history. So any particular reason as to why reduction in face value is not being distributed, given the fact that it is a tax-free component and hence more beneficial to investors?
Okay, so I would correct the first two inaccuracies. First, there is no face value of a unit, right? The units do not have a face value like a share. Right. So there is no face value that we are reducing. Because the exchanges portal requires to put a particular number, and therefore it started at 100, right? Otherwise, unlike shares, there is no face value of 10 rupees, splitting units, etc. In terms of capital repayment and interest, it is only to do with what we receive from subsidiary and pass on to investors. So that's just a reflection of that we have collected interest from subsidiary, and therefore there is a interest shield that is created at subsidiary, and therefore that is passed on as interest. The last point is, it is tax-free in the shorter term, not really tax-free in a practical way. Because when, let's say, for example, you acquired it for 100 units and you have received 100 rupees a unit and you have received 5 rupees as capital reduction. If you go and sell the same unit at 110, or let's say 100 itself, you will have to pay a capital gains tax on the 5 rupees. Yeah, that may be exempt if you hold for 3 years, etc. But essentially that reduces your cost of acquisition. So it's not a tax-free in a real technical term manner. Yes, you don't have to pay tax there and then, will not deduct TDS, but it will reduce your cost of acquisition. But if you were to sell it in below 3 years period, you will end up taking a long-term capital gains tax on that component also. But that's for individual investor. But the point is that it is just a reflection of what we receive from subsidiary and we are passing it to the investors.
Okay, and also wanted to understand, in your results on page number 16, the actual results that you have shared. Yeah, financial results. One line item that I could find was purchase of loan to GPTL. So GPTL is the new asset that you have acquired this quarter, right? So what is exactly this 225 crores that has been paid?
So let's say the seller owns shares of the SPV as well as loans to the SPV. So we purchase the loan itself. So instead of investing and repaying, we purchase the loan. It is a typical innovation transaction. So we have just purchased the loan or the instrument.
So have we not actually purchased the shares in the GPTL? Because the presentation mentions that we have purchased some 49% in GPTL.
We have purchased shares as well as loan, both. Essentially, our goal is to acquire the entire economic interest. Several sellers and promoters invest promoter loan as well as equity shares, right? Besides equity shares in the capital structure. So we acquired both shares as well as promoter loans to ensure that we have 100% economic interest of that project.
Okay. Thank you.
Thank you.
Thank you. The next question is from the line of Swarnim Maheshwari from Edelweiss Securities. Please go ahead.
Hello. Yeah. Thanks for the opportunity again. So Harsh, my question specifically is with respect to the the AUM of 30,000 crores that we are targeting by 2022. Now, the reason why I'm asking is that there are M&A opportunities in the T&D sector, and M&A in renewable will perhaps take us to something like 25,000 crores, since our articles restrict us to 25% of overall AUM. So, what is the thought process over here? I think because after GPTL, after KTL and NERSS, we will be at about 180, 190 billion. So how do we, look to take this forward?
Sure. So then we see a very active and attractive bidding market for transmission assets today, and also fresh bids. So we are seeing substantial amount of fresh bids in the sector. As we speak today, in this November, there is approximately 10,000-15,000 crores of bids that are going to take place. Depending on who the winner is, we believe eventually those assets would come for sale in the market, and next 3 years it will create that growth for us. Besides that, while we do not have specific framework on, let's say, developers' assets, Sterlite Power has 5,000-6,000 crores of assets. Other developers also have sizable assets. So we believe at the right time, all of them would also like to monetize those assets. So there would be a significant market of assets that one can buy from. So I would say we are not playing in a 6 months to a year kind of a game, right? As I earlier said, we are in a test match. So we look at 3 to 5 years of horizon. So at the moment we say that we will be playing in a 30,000, 40,000 crores of market where people will build and bid projects and eventually monetize. So I would say there is a significant, we are just, if at all 30,000 were a hard number, we are just looking at 5,000 crores for that. So it's a small number. The second point is that it's not really a hard-coded number. If at all we don't reach 30,000, we are at 25,000 crores, and we have met all other promises, I believe it's a significant size and growth and value. We will still be equally happy. Right? So neither mine nor my team or board's incentives are linked to reaching to 30,000 crores. Right? It is just a number which indicates a size, so that we work towards that. But if we don't achieve 30,000 and we are at 25,000 crores, but we are focused on stability, risk management, value creation, visibility of DPU, I think we are good. So there's
absolutely. Yeah. 25,000 crores is also a big feat. Coming from 5,000 crores to 25,000 crores, so that's also 5x AUM in 5 years. So that's certainly a big amount, really. So a related question over here, any word on the renewable acquisition? We have been eyeing some of the assets, so any word over there?
Yeah, nothing really. We are just looking at assets. As and when we make something meaningful progress, we'll definitely come and announce. But at the moment, I think there's nothing incremental. Right? We are evaluating several assets. Once we close, we'll come back and announce that.
Okay. So just wanted to understand this better. Now, suppose we acquired say 100 megawatt of assets, and this is before KTL's induction. Then will that mean that we might have to go for capital raising, as we will be very close to hitting that 70% mark?
Okay. No, so we have, even if we do a theoretical mathematics, we will still be approximately 68%. So we have a sizable gap, about 1,000 crores of debt cushion. So just because we are doing solar of 100 megawatt, we do not necessarily need to raise capital. It will not be a post-capital raise.
Right. Okay, got it. And anything of dollar bonds or ESG bonds, on our mind, because if we have to really increase the tenure of the loans, that is the only way forward. It looks like that, because banks and insurance companies are still a bit hesitant about investing in our debt products. So, what's the plan really over there?
No, we are working on it. Till now, there will be no dollar bond by InvITs. I think we'll need to work with RBI to get an approval for that. We are working on that.
Okay.
So as and when it happens, I think the yields are low, and as and when it opens up, we'll be certainly looking at that.
Perfectly fine. All right, Harsh. Thank you so much.
Thank you.
Thank you. The next question is from the line of Omkar Hadkar from Mirabilis Investment Trust. Please go ahead.
Hello. Yes, sir. So my question is on the one of the assets that you have acquired recently, where where is the state is the counterparty, the judger KT. So, and I just wanted to know, in terms of the risk, is it different from some of the other transmission assets where where Power Grid is probably the counterparty? So, is there from a risk perspective, is it similar? Both of the assets are similar, or is it?
So, I think if I were to give you an analysis and the way what we have done the valuation as well, we believe it is slightly higher risk asset in comparison to central sector, because it is a state counterparty risk.
Right.
However, it has got a 6-7 years of track record of payments and a phenomenal track record. And after we have acquired, we have also experienced it now. The payments are in a payment cycle of 15 days. Right? Not even a 60-day cycle which Power Grid cycle follows. We're getting paid in 15 days period. Right? So I would say one needs to look deeper to make the asset. So as and when we look at state assets, certainly we look at it with a magnifying lens.
Okay.
But considering your experience over here, it seems like a safer asset.
Okay. But you are open to such kind of acquisitions where you feel that the risk is not.
Oh, yeah, exactly. You put the right thing. It depends on the risk. If it's not a risky asset, we should be open to that.
Yeah. Okay. And sir, just on the renewables portion, you mentioned you want to take 20-25% kind of exposure over the next couple of years. Just wanted to know what are the sort of investments you are building in terms of the team skills that would be required to assess such assets, and what type of assets would you be looking at, whether these are connected to the grid or not. So any color on that will help.
Yeah. So we have already addressed this earlier calls. We've focused on specific set of assets which are central counterparty. We are connected with a good substation and all those things. So in terms of capability, we have a sizable team in place. Our chief operating officer was managing a large renewable energy portfolio before joining us. We've also built a team of people specifically for solar asset even before we have acquired a solar asset. So we have a head of solar asset management who has joined us from I would say a reputed solar asset owner with a decade of experience, so who only does solar operations and maintenance. He's got a team. So I would say we have built the team already in place before we have acquired the first asset. So I think we are in good shape to acquire the first few assets.
Okay. And just one question on the earlier follow-up on what Swarnim had asked on the KKR thing, and you gave an elaborate answer. Just wanted to know, let's say KKR has an asset, and then over the next 2-3 years, after 2-3 years, probably they are trying to monetize it. Then would you be looking at such kind of assets, or it will be a no-go area for you?
I think
given that KKR here is a sponsor and there.
No, so I think that's an important question, but I don't have an answer to that. I don't think it is a no-go area, right? We're already acquiring from Starlight Power transmission assets, so it is not a no-go area for sure. However, we've not thought about it, to be honest, and we've not even had such discussions with KKR. And if at all this were to happen and KKR is in a conflict position, they would not be voting. So I think that will be a neutral decision making.
Right. And so just one question on the distribution. So when you do the distribution, is there any TDS that you deduct, or is it the entire the distribution that you declare is?
No, we declare it as interest, and therefore there is a TDS component. I think right now that concessional period of 25% is there, but yeah, we do deduct TDS.
TDS. Okay. Okay. And so just one, I was for my understanding perspective, let's see, you have in first half of 21 you have given a distribution of around 6, whereas the EPS is roughly around 3 odd rupees. So probably the remaining 3 rupees, is it why it's not called as a distribution of capital? Because for an investor, this becomes like an interest, and probably the taxation is higher also.
So I think the simple way to look at it, the question is that we are actually distributing depreciation, then why not keep it as capital? The reason is that if you try to do that, you will end up paying tax at the SPV. So it's one place you'll have to pay tax, right? Either at the project level or at the investor level. Right now, to keep it similarity for all investors, we distribute a pre-tax income, and therefore each investor pays his own tax slab. Otherwise, everybody is contained to the SPV tax slab. So that's the difference.
That's it. Okay, fair enough. That's it from my end. Thank you.
Thank you.
Thank you. The next question is from the line of Hansal Thakkar from Lalkar Securities. Please go ahead.
Hi, sir. Am I audible?
Yeah.
Hi. So congratulations to you and the team on an amazing comeback from the whole COVID crisis. I just have 2 questions. The first question is, any update on that power grid InvIT? And secondly, I just directionally wanted to know, with the entry of so many people looking to kind of, raise capital through InvITs, would asset acquisition for us start becoming challenging with respect to, IRRs, etc.?
Okay. So I think the first question is, I know as much as you know, right? I mean, we know they want to do it. We have heard about it. We see some actions happening on the ground, but I think when it's going to happen is something nobody knows. So I think that's what I can say on power grid InvIT. But I think they have been talking about it very actively, and I'm sure there is going to be, they will work on that and come out with disclosures. On the other question that there will be more InvITs, I think it's as INDIGRID, we've got a scale and a head start. So there's a clear sponsor who wants to contribute capital. There's a team in place. There's a critical set of assets. So I think we do have a head start. Having said so, I think interest rates are low. When that happens, your asset prices goes up. A lot of people want to buy yield assets. So I would certainly see there is going to be competition, right, where people want to buy good assets. I would say we are better placed because of our ongoing platform, but it's no reason for being complacent. I would say as there is enough assets to be monetized, there is enough capital coming to India, so the competition would remain. Having said so, the market is just too large. Right? Today, Indian asset market, let's say if I were to say buying and selling assets, is so trivial in comparison to the size of the country and the requirement that is, that we are just scratching surface right now. So I don't think we will struggle that, it makes it a bubble or it is unmanageable because there is just so much of supply. India needs so much of capital and so much of asset supply that I don't think on the investment side you will end up having a really low returns.
Got it. Great. Thanks so much and all the best.
Thank you.
Thank you. The next question is from the line of Ravish Chandra, an individual investor. Please go ahead.
Yeah, thank you. Good evening, Harsha. Congratulations once again for the consistent growth and sharing always with the facts and figures, which gives a lot of confidence. In fact, I'm attending this quarterly call almost for last 2 years. It's going in a good way. Further, I got one small doubt, Harsha. The asset what we are acquiring from 5,000 to 30,000 crores we are planning, the longevity of this asset, is this every time it is 35 years for each asset or from 2017 35 years?
Okay. So it is different for different assets, to be honest. Some assets will have 35, some will 25, some will be 18 years left. So if you look at in a quarterly presentation, in the initial we provide a weighted average tenor, right? That's something which is easy to see, which
Okay.
is approximately 32 years of residual contract on slide number 6. And if you look at the investor presentation or even our annual report subsequently, we disclose for each asset what is the tenor outstanding. So for example, the COD that you see on page 21 will have a COD of different assets, and typically from there it is 25 years. So you will have a specific asset by asset detail over there in slide 21. But at a portfolio level, we are at 32 years as an average.
Okay. Okay. So basically, my question is to know how the DPU impact on increasing the assets. So looks like every quarter presentation, I think reducing our rate of interest on the debt will have direct impact on the DPU increase. Looks like that because all your it's a very stabilized working environment is already established under your
Sorry to interrupt you, sir. Please be online. Ladies and gentlemen, we have lost the line of Mr. Harsha. Please give us a moment while we reconnect them. Ladies and gentlemen, thank you for patiently holding your lines. We have Mr. Harsha reconnected. Thank you, and over to you, sir.
Hi, everyone. Sorry that got disconnected. We can start with Mr. Chandra's question.
Yeah. Harsha, can you hear now?
Yeah, I can hear you now.
Yeah. I was just asking about the direct means how we can interpret what is the DPU increase effect we can see on a long term on each asset adding. Maybe let us say 5,000 crore we are going to add in 2022-23. That 5,000 crore by 10 years, how we can read that one?
Yeah. So I think what will be best is we can't guide directly on which asset will lead how much. But for example, the asset that we have acquired, right, over these 2 years, we have given how much approximately NDCF that will add, right, to our books. And on a year-end basis, we'll evaluate on the total NDCF and we'll be able to give better guidance for that year for those assets. For example, we have acquired this year GPTL and ENICL. For both, we have provided guidance that we will add approximately 30 to 40 crores of NDCF. Which would be approximately 70-80 crores for the full year in terms of the cash earned. How much of that translates into DPU is largely dependent on change in working capital and reserves. So because of the COVID, the working capital was stretched, and therefore, this increase that we earned on account of acquisition was temporarily going into working capital. But as and when the things get normalized, probably it will come back and then may translate into DPU.
Okay, that's fine. The one more suggestion, in the slide number 12, in fact, the last meeting also we discussed, is it possible to show separately what is the cumulative reserve we are having? That will give a lot of confidence to investors.
Yeah, sure. That's a fair assessment. Sure. We'll try to do that.
Yeah, you told me today 65 crores roughly, but okay, maybe a ballpark figure also fine because that gives a lot of confidence to our.
Sure. Fair enough. Understand. Yeah. Okay.
Thank you, and best wishes, Harsha. Congratulations once again.
Thank you.
Thank you. The next question is from the line of Ruchit Puri, an individual investor. Please go ahead.
Thank you. Just, I think too many questions of interest have been asked, so I'll just ask you one more question. I think on the books I could see something close to 8,000 crores of debt. On a quarterly basis, the interest payout at 8.5% comes to 170 crores. But on the NDCF, it shows 90 crores. I guess that would be the actual payout. But can I assume that 60 crores is on an accrued basis, it will be something like 170 crores? Is my calculation approximately correct based on 8,000 crores and 8.5%?
Yeah, your calculation is correct. There are two gaps over here. One is you need to look at SPV level as well. So the interest calculation, if you go to slide 12, will be 91 crore plus 45 crores. So the interest will be approximately 136 crores. Right? If you add the two columns. Plus, it is a net interest. So income that we earned on cash balance also gets netted off of that. Most of the interest gets accrued also goes into the NDCF calculation as well. So it can't be such a large gap. So if you add these two, you'll be able to reconcile. Plus the timing of borrowing, right? Not all the debt is for full quarter. So.
Okay, understood. SPV probably explains the whole picture. Understood. Yeah, thank you so much. That's it.
Thank you. The next question is from the line of Gopal from an individual investor. Please go ahead.
Good evening, Harsha. Congratulations and the patience you're showing to answer all the questions. Probably some are very deep and some are very superfluous, which people like me might be asking. Even though in the COVID situation, I think the kind of performance INDIGRID has shown, I think is a commendable job. One of the doubts which I have in my mind always when I saw the earlier presentations which I was actually going through, which showed there was a projection of DPU over a period of time, and it was actually mentioned there saying that if we don't add assets, in the sense AUM doesn't increase, the actually DPU will start falling, and it goes down to probably around 8 rupees or so in a year. That's how it shows. Now, I really didn't understand why such a thing should happen. Probably if you could throw some light on that.
Sure. So some of our projects, when we did IPO, had a different kind of a tariff curve, which had a fatter tariff or a larger tariff in first few years and then going down. So that was on account of the tariff curve. However, subsequent to that, the initial presentations, we have acquired many more assets. So today, as we speak today, the DPU, even if we don't acquire, new assets other than what is there in the pipeline, would remain stable for at least 10 years.
Okay. That means it is basically because of the tariff curve.
Yeah, it's because of the tariff curve.
Okay. In the sense now the current policy or the current working method that you're considering is the tariffs are straight, or it's a straight line tariff.
Yeah.
Okay. Thanks a lot and best wishes.
Thank you. The next question is from the line of Kunal Arora, an individual investor. Please go ahead.
Hi, Harsh. I just have two quick questions. The first one was, we have about 33 crores in SPV expenses that we account for every quarter. Could you just give me a sense of what those expenses are?
So most part of our expenditure, I would say that there are 2-3 large buckets of these expenses. One of the large expenses is insurance. So we pay approximately 23-24 crores of insurance for our entire portfolio. So this is on an annualized basis about 6-7 crores quarterly basis. The second one, largest one, is AMC, or rather, if I say manpower cost or supervision cost or O&M cost. This is another sizable component, which is approximately 10-12 crores.
And this is outsourced, the AMC part?
Yes. There are in-house teams as well. For 600 people, the in-house team will be 40-50. 400-500 people are outsourced. Right? So that.
And is the AMC still Sterlite?
No. So if I look at 600 people on operations, about 60 people from Sterlite, 40 people from INDIGRID, and the rest all are non-Sterlite, non-INDIGRID. So basically partners who, let's say, who are maintaining contract at different lines in different parts of the country.
Okay. All right.
And then the third one is largely investment manager fee. So it is about 1.75% of the EBITDA. So which on a quarterly basis will be about 6 odd crores. So that's the third. So these 3-4 are the largest ones. So largely around people cost and insurance cost.
So insurance as a percentage of our fixed asset base would be roughly what? How much would we be paying? Roughly,
it will be 0.18%.
And that's comparable with, if you have to think of that from a, when you think of other benchmarks, that's something that you hope to reduce, or is that just a steady state?
I would say it's not directly comparable because a lot of, historically, most of the utilities were owned by state governments, and they never took comprehensive insurance, right? They took self-insurance. And typically self-insurance works if you have, 50,000, 1 lakh crores of assets, as well as, you don't have earnings pressure or, risk management dependent on what you earn. So they did not take a comprehensive covers. Whereas our covers are far more comprehensive. It includes loss of profit, revenue loss for any kind of damages across the portfolio. So our covers are a little bit more specific to our risk needs. And therefore we will be slightly expensive to the competitor if at all other people are taking insurance. So.
Understood. And the second question I had was, I see, we have certain payments which have been delayed over the last 5-6 months, right? Did we get the delayed receivables along with delayed interest?
Yes. So this quarter itself, for example, we received about 5 odd crores or rather 5.3 crores of late payment surcharge.
Okay, and no dispute or anything. They paid as per contract.
We recognize based on cash, especially for late payment surcharge. So we received 5.7 crore this quarter. The same number last year in quarter 2 was 4 crore. So basically, we received the compensation on account of that.
Okay. And the last question on my side is, so I understand now that Sterlite doesn't really have any formal, sort of management or steering presence with INDIGRID. It's now mostly KKR that should be driving things. I was just wondering, Mr. Prateek Agrawal is still on the board. Is that something that will change, or are we keeping him on as an independent, non-executive sort of director?
No, so Mr. Prateek Agrawal is on the board of the manager because of the shareholding of Sterlite in the manager. They own 40% today, and even after 1 year, when KKR will acquire 74% of the manager, they will own 26% of the manager. So it is not an independent position. It is the position as the own 26% shareholder of the manager, but not really as an independent. So I think the presence would remain, considering the shareholding of the manager. But with 76%, KKR controls the board, and with all the affirmatives, I think it's well covered.
Gotcha. Thank you. Thanks, Harsh.
Thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Thank you. So thank you all for participating in this call, and it is, like always, a lot of questions, and we are very happy to address most questions because we want to ensure that our investors understand the business and understand the nitty-gritties of our business and assets. So we appreciate the questions, and I would just as an outlook say we are focused on stable DPU, stable business, and the market is good for us considering the yield positions, and we will focus on continuing to add assets to our portfolio and ensure that our NDCF increases over a period of time. We are also adding a lot more people in our team. So as I discussed earlier, we had a head of solar asset management. In the leadership team, we have added Mr. Jyoti Kumar Agarwal, who has joined as a CFO of INDIGRID, and who would also be joining with me the call from next quarter. And with his hiring, I think our entire management team is complete, and we are committed to ensure stable returns to INDIGRID investors. Thank you.
Thank you.
Thank you, sir. On behalf of XSW, thanks a lot for giving us this opportunity. Over to you, Rituja. Thanks.
Thank you. On behalf of Axis Capital Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.